The Psychology of Money by Morgan Housel. The psychology of money explores a simple but transformative idea that financial success is not a hard science learned through formulas, but a soft skill driven by behavior, unique personal experiences, and emotions. While we obsess over what the rich do, we ignore who they are, the psychology shaping their decisions. This book moves beyond spreadsheets to examine the timeless behaviors that truly build wealth, like humility, patience, and a nuanced understanding of luck and risk. It reveals why smart people make foolish financial choices and how your own personal history with money creates a unique, often invisible, lens through which you see the world. Its profound lessons offer a more compassionate and effective path to managing money, one that prioritizes understanding yourself over outsmarting the market. No one's crazy. You might look at the financial decisions of others and think they are irrational or crazy. However, no one makes money decisions in a vacuum. Everyone comes from a different financial world shaped by their unique personal history. Consider Ronald Read, a janitor and gas station attendant who never earned more than a modest salary. He lived frugally, invested consistently in blue-chip stocks, and quietly amassed an $8 million fortune. Contrast him with Richard Fuscone, a Harvard-educated Merrill Lynch executive with a lavish lifestyle. When the 2008 crisis hit, his highly leveraged finances collapsed into bankruptcy. From the outside, their choices seem bizarre to each other, but they made perfect sense within their own financial realities. Your own experiences with money, though a tiny fraction of the world's total financial history, form the vast majority of your financial worldview. If you have only experienced high inflation, you will fear it deeply. If you have only known bull markets, you will be overconfident. This is the ice problem. It is hard to explain the concept of ice to someone who has never felt cold. Understanding that people operate from different financial backgrounds, not different levels of intelligence, is the first step toward empathy and better financial judgment. Luck and risk. Every outcome in life is guided by forces beyond individual effort, the twin siblings of luck and risk. Bill Gates' success is a classic example of luck. He attended one of the few high schools in the world that had a computer in 1968, giving him a massive head start in programming. But his story is only half the lesson. His friend and classmate, Ken Evans, shared that same incredible luck and opportunity. However, Kent died in a mountaineering accident before graduation, a tragic demonstration of risk. The same forces that created one of the world's richest men also ended another promising life prematurely. When judging financial outcomes, in others and in yourself, you must leave room for these powerful, unseen forces. An outcome can be 99% the result of skill, but the final 1%, the part that leads to fame or failure, is often the result of luck or risk. Therefore, be careful who you praise and admire, and be careful who you look down upon and dismiss, as the line between success and failure is often drawn by luck and risk, not just effort and talent. Never enough. The most destructive financial mistakes often occur after someone has already achieved substantial wealth, driven by a failure to define a point of enough. Consider the story of Rajat Gupta. He was the celebrated managing director of McKinsey & Company, a global icon of business wisdom. He sat on the boards of Goldman Sachs and Procter & Gamble, with a net worth well over $100 million and a reputation of immense value. Yet he risked it all. He illegally tipped a hedge fund manager with insider information, a crime that earned him a few $1,000,000 but cost him his freedom, his reputation, and his legacy. He had so much, but in his mind, it was not enough. On an even catastrophic scale was Bernie Madoff. Bernie Madoff operated the largest Ponzi scheme in history. He was already wealthy, a former NASDAQ chairman living in luxury. But his desire for more status, more control, and more unending growth drove him to fabricate consistent, impossible returns for decades. He used new investors' money to pay fake returns to earlier investors, a scheme that required constant, exponential inflows of cash to sustain. When the 2008 financial crisis sparked mass redemption requests, the fraud collapsed, wiping out $65 billion of his clients' life savings and leading to his 150-year prison sentence. He had enough wealth for 100 lifetimes, but sacrificed everything for more. The hardest financial skill is halting the moving goalpost. There is no reason to risk what you have and need for what you don't have and don't need. The relentless pursuit of more, fueled by ego, can destroy a lifetime of accumulation in a single, unforgiving moment. Confounding compounding. Warren Buffett is a phenomenal investor, but his secret is less about genius stock picking and more about the sheer, unmatched duration of his investing career. His net worth is not merely a testament to high returns, but to the staggering power of compounding over time. Consider this. Over $81 billion of his $84 billion net worth was accumulated after his 50th birthday. The man started investing in his early teens and has continued well into his 90s. That is nearly 8 decades of uninterrupted compounding. Compounding does not resonate intuitively because we rarely see its effects in our short lives. It is like planting an oak tree. A single year of growth is barely noticeable, and it is easy to get discouraged. But the majestic growth that occurs over 30, 40, or 50 years is impossible to replicate through any other means. Good investing, therefore, is not necessarily about earning the highest returns, which often require taking extreme risks that are hard to maintain. It is about earning pretty good returns that you can stick with for the longest period of time. The key is to stay in the game, to let the mathematics of compounding work its quiet, relentless magic over a lifetime. Getting wealthy versus staying wealthy. There is a critical difference between getting money and keeping money, a distinction requiring opposite mindsets. Getting money often demands risk, optimism, and a degree of boldness. Keeping money, however, requires humility, frugality, and a paranoia that what you have can be taken away quickly. The trader Jesse Livermore perfectly embodies this dichotomy. He was a genius at making fortunes, famously shorting the 1929 crash. But he could not hold on to his wealth, repeatedly losing everything through risky bets and ultimately dying broke. Getting wealthy is about maximizing returns. Staying wealthy is about surviving, about ensuring that no single event or mistake can wipe you out. This is why a margin of safety or room for error is paramount. You must manage your finances not just for the future you hope for, but for the future you cannot predict, building a financial life robust enough to withstand the inevitable surprises. Tails, you win. A small number of events, the tail events, account for the majority of outcomes in finance and life. You can be wrong half the time and still generate phenomenal wealth if your right decisions are concentrated in a few, massively outsized wins. Venture capital embodies this principle. A typical fund might make 100 investments. 50 will fail completely, 40 will return the original capital, 9 might double or quintuple the money, and one single investment will return 100 times the initial stake. That one tail event pays for all the losses and generates the fund's entire profit. My own career is a tail event. A single article I wrote went unexpectedly viral, leading to a book deal and defining my professional path, an outcome I never could have predicted. This reality changes the strategy. Since you cannot predict which endeavor will be the tail, you must be willing to experiment and endure many failures. The key is to remain in the game long enough for your own tail event to occur, ensuring you are exposed to potential upside without being wiped out by the many small failures along the way. Freedom. Nelson Mandela wrote that he only began to hunger for freedom after he learned his childhood freedom was an illusion after it was taken from him. This underscores a profound truth. The value of something is often most acute in its absence. The highest dividend money pays is not the ability to buy more things, but the ultimate freedom to control your time. The real value of wealth is the independence it provides, the ability to wake up each morning and say, "I can do whatever I want today." This control over your schedule and your choices is becoming one of the world's most valuable currencies. Wealth is what enables you to say no to requests and obligations that do not align with your goals or values. It is the power to spend your days as you see fit, whether that means pursuing a passion, spending time with family, or simply enjoying solitude. This intangible benefit, the flexibility and autonomy that financial resources can secure, far outweighs the fleeting satisfaction of material luxuries. True wealth is hidden. It is the unseen option to live life on your own terms. Man in the car paradox. This paradox reveals a fundamental misunderstanding of how status symbols work. When you see a person driving an expensive car, you rarely think the driver is cool. Instead, you think, if I had that car, people would think I'm cool. This is the paradox. We buy luxury goods to impress strangers, but those strangers are largely indifferent, using your car only as a benchmark for their own potential purchases and status. They are too busy thinking about how they can impress others to be genuinely impressed by you. Spending significant money on flashy items to gain respect or admiration is therefore a futile endeavor. The admiration you seek does not materialize in the way you expect, as everyone is the main character in their own story. Realizing this can free you from the expensive cycle of competitive consumption, allowing you to use your money for things that genuinely increase your happiness, such as security, independence, and peace of mind. Wealth is what you don't see. Wealth is hidden. It is the money not spent, the financial assets that have not been converted into the expensive cars, watches, and homes you see. When you see someone with a $10,000 watch, you are not seeing their wealth. You are seeing the exact portion of their wealth they have destroyed to buy that watch. True wealth is the gap between your income and your ego, the ability to forego current consumption for future financial security. The most impressive financial stories are often the most boring and invisible. The person who lives modestly in a small house while accumulating a fortune in savings and investments. Spending money to appear wealthy is seductive but counterproductive, as it directly reduces your actual net worth. The foundation of lasting wealth is not a high income, but a high savings rate, which is fueled by humility and a lifestyle that burns less fuel than your engine produces. Save money. The single most powerful financial factor under your direct control is not your investment returns, but your savings rate. Future market returns are unpredictable and unknown, but how much of your income you choose to save is a deliberate decision you make every day. A high savings rate provides three distinct advantages. First, it builds wealth directly and predictably. Second, it creates an invaluable buffer, a room for error, that protects you from unforeseen job loss, emergencies, or market downturns without forcing you to sell assets at a loss. Third, and most crucially, it provides flexibility and options. Savings give you the power to wait for the right opportunity, to take career risks, or to endure periods of low income without financial panic. While everyone focuses on the mystery of high investment returns, the real key to financial resilience and independence is the humble, disciplined act of consistently spending less than you earn and building a pool of liquid savings. This is the foundation upon which all other financial strategies are built. Reasonable versus rational. In finance, striving for cold, perfect rationality is a flawed goal because humans are not perfectly rational beings. A better aim is to be reasonable. The difference is illustrated by the ice-water analogy. Rationally, you know that a glass of ice water is safe to drink even after being used by a sick person, as germs cannot survive in freezing water. Yet, reasonably, you would likely hesitate or refuse, driven by emotion and disgust. This gap exists in all financial decisions. A perfectly rational investor might leverage their portfolio to the maximum to optimize returns. A reasonable investor, understanding their own capacity for fear and panic, maintains a margin of safety to sleep well at night, even if it means slightly lower theoretical returns. The goal of finance is not to maximize wealth on a spreadsheet, but to maximize your chance of achieving your personal goals and finding happiness. A reasonable strategy that you can stick with through market cycles is far superior to a theoretically optimal rational strategy that causes you stress and leads you to abandon your plan at the worst possible time. Surprise. History is fundamentally the study of surprises, and the most important lesson it teaches is that the future will not look like the past. The greatest economic and market events are almost always unforeseen. They are the surprises that rewrite the rules. This is why extrapolating recent trends into the future is a dangerous fallacy. In the short term, the economy and markets are driven by psychology, news, and emotions, making them inherently unpredictable and full of surprises. However, over the long term, the fundamental drivers of growth, such as innovation and productivity, are more stable and reliable. The practical application of this insight is to build a financial plan that does not rely on a specific, predicted future. Instead, you must construct a plan with a wide room for error, one that is robust enough to withstand the inevitable surprises, both positive and negative, that will occur. Your strategy should be flexible, allowing you to adapt when the world inevitably changes in ways no one could have anticipated. Room for error. The ancient Indian strategist Chanakya served as an advisor to the emperor in the 4th century BC. In his foundational text on statecraft, the Arthashastra, he delivered a crucial lesson on preparedness. The king shall lose no time when the opportunity waits. This was not a call for reckless speed. Chanakya was a meticulous planner who argued that a king must maintain a massive treasury, a vast surplus of gold and resources. This treasury was the kingdom's ultimate room for error. It was this financial buffer that allowed a ruler to act decisively, whether to fund a sudden war against an invader or to seize a fleeting economic opportunity, without being paralyzed by lack of funds. The most important part of any financial plan is planning for your plan to fail, which means building a robust margin of safety. This concept is borrowed from engineering, where bridges are built to hold several times the weight they will ever actually carry. This buffer is not inefficient. It is the key to long-term survival. In finance, a margin of safety means holding more cash than you think you need, taking on less debt than you can theoretically afford, and expecting lower investment returns than historical averages suggest. This humility acknowledges that the future is inherently uncertain and that your own predictions will often be wrong. A room for error gives you the durability to withstand unforeseen job losses, market crashes, or personal emergencies without your entire financial life collapsing. It provides the staying power to remain invested during downturns and the flexibility to take advantage of opportunities when others are forced to sell. You'll change. We all suffer from the end of history illusion, the belief that the person we are today is the finished product. We acknowledge our past evolution but underestimate our future transformation. This has profound financial consequences, as we make long-term plans for a future self whose desires we cannot accurately predict. I experienced this myself. Early in my career, I was obsessed with extreme frugality and the goal of retiring as early as possible. I envisioned a future where not working was the ultimate prize. But as I aged, my goals evolved. I discovered that I genuinely enjoy the work I do, the structure it provides, and the intellectual engagement. My goals shifted from escaping work to finding fulfilling work with maximum flexibility. This is a common evolution. Therefore, you should avoid the extreme ends of financial planning. An ultra-frugal life spent miserable to retire early is a bad bet if your future self would prefer a more balanced, engaging life. The most effective financial plan is one that is flexible, one that keeps as many options open as possible for the person you are likely to become. Nothing's free. Everything valuable in investing has a price, but its currency is rarely just money. The real price of superior returns is paid in volatility, fear, doubt, and regret. These are the hidden fees of the market. Everyone wants the return, but few are willing to emotionally stomach the fee when it inevitably comes due. This is like a restaurant bill. The menu shows the delicious meal, which are the potential returns, but the price is easy to ignore until the bill, such as a market crash, is placed in front of you. Many investors abandon their strategy at this point, realizing too late that the emotional cost was higher than they were willing to pay. A successful investment is not just one that generates a high return, it is one where you understood the psychological price tag up front and were prepared to pay it without panicking. You and me. When we see others make financial decisions we disagree with, we often label them as irrational. The problem is we assume everyone is playing the same financial game with the same rules and goals. In reality, investors are driven by wildly different personal histories, time horizons, and goals. A day trader is playing a game of short-term price movements, while a pension fund manager is playing a game of 30-year liability matching. An immigrant who lived through hyperinflation views cash as risky, while a young tech employee sees it as safe. These are not just different strategies, they are different games entirely. What looks irresponsible to you may be perfectly rational within the context of their unique financial world. The key to better financial judgment and less frustration is to cultivate empathy. Before dismissing someone's money decisions, try to understand the game they are playing, the goals they are chasing, and the personal history that shapes their perception of risk. Their actions make perfect sense from their seat, just as yours do from yours. The seduction of pessimism. Pessimism is intellectually seductive. A pessimist who predicts doom sounds like a critical thinker, while an optimist can sound like a gullible cheerleader. This is because progress is often slow, quiet, and boring, accumulating over decades, while setbacks are sudden, dramatic, and headline-grabbing. Our brains are wired to pay more attention to potential threats, a trait that was essential for survival in the wild. However, in a modern economy that rewards problem-solving and innovation, this wiring is a disadvantage. Optimism, not pessimism, is the better strategy for financial success. An optimist believes the odds of a good outcome are in their favor, which allows them to take the calculated risks necessary for growth. The relentless, quiet march of progress in technology, medicine, and commerce has consistently proven the pessimists wrong over the long run. While pessimism sounds smart, it is often the optimistic belief in a better future that pays the highest dividends. When you'll believe anything. In the absence of a clear, data-driven story, people are susceptible to believing almost anything, especially if it's a compelling narrative. This is exploited by financial entertainers and the media, who provide exciting stories that are more memorable than boring statistics. Our brains are wired to prefer a good story over a complex spreadsheet. This explains why we fear dramatic, low-probability events like a nuclear war more than we fear boring, high-probability threats like heart disease from a poor diet. One has a terrifying narrative, the other does not. In finance, the more you desperately want a certain outcome, which could be a simple secret to getting rich quickly, the more likely you are to believe a story that overestimates the odds of that outcome being true. This is the fertile ground for get-rich-quick schemes and investment fads. The remedy is to be aware of this vulnerability and to favor evidence and reason over emotionally charged narratives, especially when the story being told is exactly what you want to hear. Altogether now, financial success is not about finding a secret formula, but about combining several reasonable behaviors. Understand that everything has a price, and for investing, the fee is paid in volatility and fear. Have a margin of safety to survive the inevitable surprises. Define enough to avoid catastrophic risks. Save money, as it is the one factor under your control that provides flexibility and options. Be reasonable, not coldly rational, crafting a strategy you can stick with. Understand the role of luck and risk, and that tail events drive most outcomes. Grasp that the highest dividend money pays is control over your time. No single strategy works in isolation. It is the combination of these ideas, humility, patience, and margin of safety that forms a robust financial mindset capable of navigating an unpredictable world. Confessions. My own investment strategy is simple and reflects the lessons in this book. My wife and I own our home and invest our savings in a single portfolio composed entirely of low-cost index funds. We deliberately avoid individual stocks, actively managed funds, and cryptocurrencies. I know this approach will not maximize my potential returns, but that is not my primary goal. My real goal is to maximize my peace of mind and completely minimize any future regret. This simple strategy frees me from the need to constantly predict the market's next move or worry about picking individual winning stocks. It removes the stress of tracking daily financial news. My entire financial plan can be summarized in one sentence. I save as much money as I possibly can, and I invest it all in a portfolio designed to perform well over a 30-year horizon without me ever interfering with it. I believe the best financial plan is never the most complex or ambitious one, but rather the simplest one that you can understand completely and stick with consistently through every market cycle without losing sleep. Thank you for listening to this audiobook. Your interaction matters, so don't forget to like, share, and subscribe.